Live streamed. All right, we are streaming live. Nate, it is Tuesday, June 20th. We are here. We're going to be talking about some of the deals that we just put under contract, closed on, and are bringing full cycle. We're going to be talking about some upcoming deals that we're doing as well. For those of you who are new to the Home Invest world, his name is Nate Armstrong. He's the founder of Home Invest. My name is Steve Warner. I am the chief investment officer here. We have Sue on the call as well. We're here to provide you great outlets to invest passively in real estate. Most of our deals pay up to a 16% IRR. We also aim for a 1.8x multiple. We'll get into what those things mean a little bit more. But we're here to talk to you about current deals that are going on in our world, the world of multifamily real estate as a whole, kind of give you guys some insight and our latest takeaways. Nate has done more than 1,500 deals at this point in his real estate career. A good portion of those have been multifamily. We've also been in the syndication world for a while. Nate, how are you doing today?
Doing good, man. Doing really good.
Awesome. So we are going to jump in and we're going to talk about one of our multifamilies that we just brought and went through the investment process with, just so that people can understand. Do you want to share that with us? I don't know if you have a slide ready or how you want to get into that.
Yeah, I'll tell you what, I'm going to load it up on my screen. If you want to just give some of the preview, I'll pull it up and have all the images ready in just a sec.
Yeah, no problem. So for those of you who are newer to our world, most of our multifamily right now is in Louisville, Kentucky. We are focusing on properties that are right around, I would say, $5 to $8 million in total spend. That's the investment that we take to get into them. We're going to talk about why we focus on that versus, the 15, 20, and $25 million range. These are smaller multifamilies, but they give very good opportunity for forced appreciation. These are all found using our off-market methods. So none of these come through brokers. None of the other big syndicators know about them, which means we can usually get them, and they're historically, we always aim to get them somewhere 20% plus under market rent. Nate, I'm going to let you take it over from there.
Cool. So this is a smaller deal that we just took, but I'm going to explain why we took this one and kind of go on that same theme that Steve has been talking about so far. So although there are 40 million, 50 million, $100 million deals out there, that's not where we go. Okay. Here's why. That realm, especially when you start to crest like 25 million, that whole arena is just crowded by large funds. I'll give you an example. Life insurance companies. When life insurance companies take your premiums for life insurance, they have to make a return on that money. It's the only way that they can actually pay out for claims and pay out things like the dividend payments that they pay. How do they do that? How do they get you 6% or 5% or 4% guaranteed on your money? Well, they're taking that money and they're placing it in places that make them money as well. One of the biggest placements that they do is in real estate. And which real estate do they choose? They choose the big stuff, the downtown buildings, the big multifamily properties, the really big storage units. And so that's typically where you'll find large placements of capital. The other one are pension funds, retirement accounts that are managed collectively like big unions. A lot of them are also crowding the multifamily space. And so we don't want to have to go compete against a life insurance company that's placing $75 million with one placement. I don't want that as my competitor. And so consequently, we go down for properties like this one. I'll get through the details in just a second, that are a little bit smaller, but they're way under the radar of the big funds that are out there. And so we can come in and we can actually find more return, find a little bit more of the equity multiple, which I'll define in a little bit here too. So this particular property, this is a little 22 unit building. This one's not available anymore. We fully funded this as soon as we published it. but I want to explain why we went after this. So 22 units, historic district. We took over the existing financing at 4.33%. It's hard to do that. Really, really hard these days. Most people that are taking out loans, they're paying anywhere from the high sixes to even the 8th percentile range for properties like this. And this is for investment property, not for a personal house. So it's really high interest. So when we scored this at 4.33%, we knew that it was a winner just from that one thing that it's the biggest payment that you make on the properties right there is going to mortgage debt. But it's a nice place. Like literally when I say historic district, I really mean that. It's legally in the historic district of this area. And the property's been well preserved. It looks it like it's just a beautiful little brick building. So the upside on this one for us is that the owner is absentee and the owner hasn't increased rents like they should have. A lot of people over the last 3 years, especially since they got hit with COVID, not like physically sick, but I mean like the market got hit with COVID. A lot of people didn't touch rents in fear of losing a tenant, in fear of violating some government rule during the COVID era. And so consequently, a lot of people fell behind on raising rents up to market rent. In this particular property, we happen to own another asset just a few blocks away from it. And we're dominating with rent rates on that one. Like we're doing very, very, very well above our original projections. And so stepping into this one, we're using the same exact management team and we already know what it can rent for. And it's in actually a little bit better area because it's a historic district area. So it was just a slam dunk deal for us. Does that kind of make sense at a high level, Steve?
Yeah, absolutely. A few things that I want to pull out there. The first one is we already own another asset that is in this area. That asset, we were able to raise rents. I feel like people might say, well, if they weren't able to raise the rent for a while, what makes you think that you're going to be able to go in and raise it? Are you going to lose tenants? Are you going to have high turnover? Can you just walk us through what that looked like when we did that on the other property? And we've already started to do it on this property.
Yeah. So the easiest way for people to measure like what rents will be is they forecast by looking at other buildings and compare it. They call that comparable market analysis. And we could certainly do that on this building, which we did, but we have something better than a comparative market analysis. The one challenge with comparative market analysis, when you're like spying on other people's buildings, trying to figure out what their rent rate is that you don't know all of the incentives that they provided to the tenant to achieve the rent rate that they achieved. So as an example, a neighboring property might be renting at, let's just say on a per square foot basis, a neighboring property might be renting at $1.61 per square foot basis. But did they give them 1 month free to sign a 12-month lease? Did they give them a big screen TV to sign a lease? Did they give them free parking for a year to sign a lease? You don't know those things by looking at comparable sales. So the best way to have comparables is if your own property is the one setting the rent rate, or if you've got a property right next door that's setting the rent rate. And so we happen to have a property right next door that's setting the rent rate that we own. We know that there's been no incentives given, like we're just doing straight up regular rentals. We know that we didn't give away big screen TVs to achieve it. Now, let me break that down numerically for you. Okay, when we wrote the pro forma for this property, we need to raise rents to $1.35 per square foot. If we hit that, we hit all of our financial projections for our investors, all of them across the board. Okay, on our other property, a few blocks away, we're already beating that. We're getting upwards of $1.51 per square foot rent rate. And so we know that this building, like we conservatively looked at all of our pro formas and we knew that we'd be able to achieve this because we're already achieving it 3 blocks away. And this property is 3 blocks in a better direction in the historic district, just a little closer to town, more convenient for people.
Cool. I was just running some calculations, Nate, as well. You said we got this at 4.3%. So
3.3, yeah.
4.33 versus average rent right now is around 6.5%, 7% for multifamily. what does that mean to an investor? Like, why? I know everyone says like lower is better. How is that going to shake out over the term of like quarterly payouts, as well as what's that going to mean at the end when this goes full cycle 3 to 5 years from now and we're exiting the property? How does that interest rate actually play out in favor of the investor? Because this is something, if you guys are looking at multifamily deals, we invite you to look at everyone's deal, not just ours. One of the things that you're going to want to look at is what is the interest rate that they're getting? What's the term on that? Like right now, we're running into a lot of people. You see people out there that took short-term loans and they're not able to refinance out. They're having to go do capital calls. They're having to have really tough conversations with their investors, and they're having to put the property up for sale before it went full cycle. So one of the things that you want to pay attention to is the interest rate and the term of the loan. Nate, can you just kind of walk us through that?
Yeah, very, very good analysis, Steve, and questions. So what it means physically when someone's out there paying 6 or 7% interest versus us paying 4.33% is that our payment to the bank each month for the debt is much less than someone paying 7 or 8 or 6 to 8% range. So what does that mean for our investors? More cash flow, more profit, more money going to the investor, less money going to the bank. That's kind of the black and white way to look at it. The second part of your question on the term of the loan, this is very important. A lot of people that got in trouble back in 2008, 2009, they were taking out loans that adjusted. They had rates that they got into at maybe a low interest rate today, but then a year later or 2 years later, all of a sudden they started skyrocketing up. And that's when they got into big trouble. We saw a syndicator that did that down in Texas not that long ago. They took out one of those adjustable rate mortgages, and unfortunately, they didn't finish the project to the level that they needed to finish it. And additionally, insurance rates crept up quite a bit. And unfortunately, they couldn't refinance. They couldn't get the job done. And so they ended up losing that property. And so it's really, really important that whether it's our deal or somebody else's deal, like you ask the questions like, hey, what does the financing look like? Part of the reason that we really like this loan at 4.33% and beautiful building, beautiful property is because it's fixed for the duration that we're going to own this asset. We feel really, really good about that. I wouldn't want to get into something where you're only taking out a 1-year arm and then you can get a goofy interest rate on the backside of that subject to market conditions.
All right, Nate. So that brings me to the next piece. Like when you're looking for an investment property, there are different ways that you make your money. Some people are buying, they're going in and they're doing a lot of heavy renovation. That would be like a value add situation. Some people are buying, hoping that they're buying in an area that's appreciating quickly. We're doing something called forced appreciation. If we can give a high-level overview and show how that worked in this property. If you guys want to see current offerings that we have, Nate's showing you the one that we just filled. We have another one that we have the LOI, our letter of intent out on, and we should have under contract within the next week or two. If you guys would like penciled in for a spot on that, we are taking accredited investors. You can go to homeinvest.com. You can book a call with myself, Sue, or Nate there. We'll be happy to run you through the property that we're working on right now. But Nate, if you can kind of cover the forced appreciation model and what that means. It sounds different than it actually is.
This is probably the biggest reason that I like multifamily heading into a recession. So in a recession, single family home investors, especially the ones that are doing like the whole buy, fix, and sell thing, flipping houses, those are the ones that are taking on the most risk right now. The reason is because someone that's buying, fixing, and selling, they're buying it today. Don't get me wrong, there was a season for it. There was a season, it was great. But today, they're buying it at today's market price. But if inventory stacks up and prices shift down, they have to sell into a lower market. And so someone that's doing a buy, fix, and sell in a single family house, they're dictated by the market. The market controls everything. The end buyer is only going to pay whatever it appraises for. Now, compare that to multifamily. Multifamily is driven by the rent rate. Technically, it's driven by the net operating income of the property, which simply means how much are all the rents minus the expenses, what does that profit line look like? The net operating income. When we can increase the net operating income on a property, we increase the value of the property. It doesn't matter what's happening in the economy. It doesn't matter that single family houses went down in value. None of that stuff matters. All that matters is what is the net operating income of the property. And typically, even during a recession, we can get rent increases. Now, that's true for properties that I bought in 2007 that I watched go down in, like, I watched other people's single family houses go down in 2007 in value. And I watched my rent on my multifamily property go up during 2008, 2009, 2010, 2011, right through the recession. Now, I realize that there's some cities that maybe hyperinflated a little bit too much. There's some cities out there that you're going to see some rent setbacks, like Phoenix, Arizona, San Diego, California, some of the ones that just like totally hyperinflated over the last 3 years. It's very different in Kentucky. Kentucky, where this property is, and where the next one that we're apt to take, that Steve mentioned, the 58 unit that we've got a letter of intent out. That state's very much more mellow. It's a more conservative curve. It doesn't have the same highs and the same lows that some of the other markets do. And so we're still seeing rents increase in the state of Kentucky. We're budgeting conservatively, though. We're not planning on any hyperinflation happening with our rent rates. We're going with standard models for every single one that we do.
Nate, we're actually very conservative in the way that we lay out our plan. Our general thesis is we are looking for an internal rate of return of about 16% and a 1.8x multiple. And you're achieving that by looking at sometimes hundreds of properties to find one. And then in that property that we find, you're using very conservative modeling. Tell us about, one, what we can expect, what we expected on this property, what we expected on the other property, because we've talked about two properties now, the one that's next door to this one, the one that we just did, and then the one that we have the LOI out on. If we can just compare the three of those so people understand what our investment thesis is and what we're looking to do. If I'll take it after you do that one. Yeah.
So let me explain the IRR, what that means first. So when Steve's mentioning up to 16% IRR, part of profit on these projects comes from rental income. That's like, the monthly cash flow that comes in. So part of the profit comes from there. But the bigger part of profit on projects like this actually comes from resale of the property. So even though we're buying multifamily property, and even though it's a cash flow property, cash flow play, where the real profit is when you increase the net operating income and you sell it to a new buyer, a new group of investors that are trying to buy in the same area. And so we buy these properties under rented with the anticipation of going in there and increasing the rents and then turning around and selling sometime between 3 and 5 years later. Our internal rate of return of 16%, about 1/3 of it is made up from the actual rent collections. 2/3 is made up from the resale profit from the sale. So we do distributions along the path. We pay out basically that rental income that's coming in every quarter. And then the bigger chunk of profit comes as soon as we sell the property. That's at the 3 to 5 year mark. That's how we get the 16% or up to 16%. Part of it from rents and the majority of it from the resale of the property. Let's talk a little bit about equity multiple. What that means is that when someone puts in $1 and we complete this project, let's just call it 5 years later, if you can get $2 back, then that would be a 2x equity multiple. Put in $1, get out $2. So you're basically doubling money. Our goal for these projects, we underwrite conservatively, and we could certainly hit the 2+ mark, but we like to underpromise and overdeliver. And so we go after 1.8. Put in $1, get out $1.80, $1.80 out of the project when we finish the project.
Cool. I think that's the most straightforward, easy to understand explanation. If you guys have any questions, I know there are some people joining us on social media right now. We have some people here with us live. Patty, Ann, I'm glad you guys have your cameras on. I love seeing smiling faces. It's always nice. Look at that smile. That's wonderful. Sue's got a great smile too. One of the questions I've gotten is, shouldn't we be looking like, doesn't a development project pay a better return if we were to go develop homes? There are a couple reasons that I feel like you probably don't want to be in a development syndication right now, going into the recession. But Nate, you can explain this much better than I can.
Yeah. How much pain do you want to talk about, Steve? So we've lived, like, we've done a lot of projects in our lifetime, and I just know during a recession, jumping into development is just not the smart play. So I'll just say it with love. I've seen a lot of people, like somebody brought me probably 6 weeks ago, an investor of ours currently that wanted to invest into development projects, and he wanted to put maybe $250,000, $300,000 into it. And he's like, Nate, I'm going to do this because it's paying a 35% return, 35%. And he's like, what do you think? What do you think? And I said, hey, I don't want to steer you in the wrong direction. I just want you to answer these questions. What happens if bank funding dries up for that project? What happens if credit gets tight? What happens if more banks collapse and there's not funding to finish that project? Just think about those things. And then I said, if it does get finished, if the funding does come through and you get all the way to the finish line with that development project, do you think that there's going to be the same demand to rent that facility in the middle of a recession? Do you think that they'll hit the same projections on their rent numbers in the middle of a recession? Or do you think that businesses might recoil a little bit? Think about those things. And so I left him with those questions, and that's the same questions that I'd toss back at you, Steve. If someone's looking at a development project, you got to think about the financing. Financing doesn't always come through all the way to the finish line. You got to think about, hey, will this knock down our projections? And then what happens? Worst case scenario, if the projections, if rentals for businesses or whatever the development project is, if they have to come down, will the property still cash flow? I was sent a deal in Miami over the weekend, and on paper today, it looks solid. It's like a solid 6 cap property, capitalization rate, and the average investor would probably take it. And the client that I'm helping on this one, he said, hey, would you take it, Nate? Just give me a straight answer. And I said, no, I wouldn't. He said, why? I said, well, Miami's been on a run now for the last basically 7 years. It's had a really, really good run up for the last 7 years. And if you try, I always look at the stat of the income ratio to the purchase price per unit, income ratio to purchase price per unit. And I said, if you look at Miami right now and you look at what people are getting paid in their jobs, what their income is, it does not support any more rent growth. It's way out of norm for normal for Miami right now. And the last time that we saw that happen, we saw a crash. That was 2008, 2009, 2010. And so I told him, I'm like, no, that Miami deal, I wouldn't take. I'd pass on it, even though it looks okay on paper today. I would pass on it. Here's why. And he said, thank you. I so appreciate your wisdom. I'm passing.
So we talked about it. I'm thinking more now that you brought up Miami and you're talking about places like that. Like what makes Louisville specifically a better offering than Miami or other places? I know we can talk about job growth. I know we can talk about overall city growth, but that's a good point. Like Miami has been on a run. Austin the same way. Like I live in Austin. Those of you who don't know me, I live here. Tony, thanks for having your camera on. Always nice to see smiling people. I live in Austin, and we saw the same thing here over the last 3 years. It's been going steadily up. And now that there's a tech recession, like a lot of tech people getting laid off, we've seen inventory go through the roof. We've seen rents kind of flatten off. It looks like you might be pulling something up. Nate always has all the stuff.
I was looking for a chart that I could show you, but I can't quite find it right yet.
It's all right.
Yeah, but Austin, and what happened in Austin now? What is Austin doing right now after that big run up?
I mean, so this is the nice thing about multifamily. Rents have stabilized. They have not gone down yet, but there is a lot more inventory on the market right now. It also has to do with there's a lot of building. So if you look downtown in Austin, there's a ton of building going on right now. And actually, two of the projects have halted due to loan problems. So it's interesting to see that coming out of the woodwork again.
It's just totally like in everything that I'm saying right now, none of this is like groundbreaking. I'm not a rocket scientist, nothing like that. It's just the playbook. It's the same cycle that the Fed took us through 2007 to 2012. I'm just rehashing the steps again. So the last time that the economy got in this position, it was because the Federal Reserve juiced up the interest rates. They juiced up the interest rates from 2005 to 2006. And then in 2007, things slowed down. 2008, things crashed. And the one thing that weathered the storm during that was multifamily real estate. Multifamily real estate hung tight. Why? Because rents went up. When homeowners were foreclosed on and didn't have their single family home to live in, guess where they went? They went to multifamily. And so with all investment asset classes considered, like I feel the strongest about multifamily real estate. I can make a pretty strong argument for self-storage right now too, but that's a different topic, different day. Multifamily real estate is the place that I'm going all in during this recession on.
Awesome. Nate, let's just talk a little bit. We can tease people about the property that we have the LOI, the letter of intent out for. We've kind of covered our investment thesis here so that you guys understand why we pick Louisville, Kentucky, why we're picking the properties that we're picking, how they're coming to us. They're 100% off market. These don't come through brokers, which usually leads to us getting a much, much better deal. The two deals that we talked about earlier, we have already funded and we're already working on. We're already bringing rents up to market rate, and we've done very well with. The one that we have right now, Nate, do you want to tell us a little bit about it?
I have a rule, Steve.
Uh-oh.
I can't talk about the deal until it's a deal.
Okay.
We'll say
Fair
this.
enough.
It's a 58 unit building. It will definitely hit the 16% IRR as long as we get it for this price. It's not a done deal yet. We submitted an LOI. The seller wanted to take it and try to get other offers. And we stood our ground and we said, hey, if you take this and like shop it out there and try to push us into multiple offers, we're going to end up lowering our offer. Like we put a good solid offer forward up front. And so we left it at that. And I'd give it like a 95% chance that we'll hear back tomorrow as a yes. But I have a rule to not talk about deals until it's a real deal. Otherwise, it just, sometimes they don't come. Yeah.
Fair
Is
enough.
it in Louisville or Lexington?
I'm not saying.
Okay.
All right. If you guys would like to hear more about it, if you would like to book a call with us and get penciled in for a spot, the last two offerings that we made, we filled in under a week. We pretty much filled through our list of investors. So if you guys would like information on that, you can go to homeinvest.com/book. Nate put the link in the chat. If you go there, you will end up on a call with myself or Sue. We'll be happy to talk to you a little bit about what we can share. I won't share anything Nate doesn't want us to, but we can get you penciled in for a spot. We'd love to hear from you. If you guys have any questions about multifamily, the state of the market right now, real estate in general, Nate spends, I would say, the majority of his week researching and doing things real estate related. I spend quite a bit of time there, as does Sue. We'd be happy to take some questions from you if you have anything we can answer, whether it's about one of our properties or the market in general. Happy to open it up to some questions.
Cool. Steve, one thing that I would also add, Sue reminded me of this. So having the power team makes all the difference too. Like we have property managers, we have contractors, we've got the whole team assembled. And so like going from the first asset to the second asset, that's only 3 blocks away, that was a power move because we've already got a working system for churning over units and a working system for leasing units really efficiently. The whole team works together. And if we get this 58 unit building, it'll just be one more asset that works in the whole system. So that's really, really important when doing multifamily property like this. If someone's trying to do it 100% remote and they don't have the team and they don't have the momentum, it will take them much longer to get off the ground and up and running. We've already got the system churning these units.
Awesome. Patty, Tony, Ann, John, Boris, anyone have a question or anything that we can help you with when it comes to multifamily real estate? So we're happy to share some knowledge with you.
And for everybody on social media right now too, that's following along, if you've got questions or if you want to connect on a call, just type it in the chat and our team will connect with you for sure. We'll make sure that your questions get taken care of there.
Awesome. If you guys are new to syndication, you might be wondering, how do we invest, or what does an investment look like, or how long does it take to get money back? Nate, if you could kind of walk through that a little bit, quarterly dividends and end of cycle payouts.
Yeah. So first thing, the SEC requires us to do accredited investors only, which simply means there's no like formal thing you get from the government or an accreditation department. What it means, it's a income or net worth requirement. The income is either $200,000 as an individual or $300,000 as a married couple. And that's the income requirement. If you hit those, you're good, one or the other. And then the net worth requirements, this is the other option. You don't have to have both of these. It's one or the other. It's having $1 million net worth, not including your personal residence. So anyone with $1 million net worth, or if they make the income requirements, then they are considered an accredited investor. We do $100,000 minimums on all of our properties that we do. The term is generally 3 to 5 years, depending on the project, but it's usually 3 to 5 years. The way it works is that you would jump on a phone call. We want to make sure there's a really good mutual fit. We are not hurting for capital. We're also not like desperate to get deals done. We're the patient type of people. We want to make sure it's a really good deal, and we want to make sure that it's a really good partnership. These are typically 3 to 5 year kind of deals. So we want to make sure that it's a good fit for everybody. So we jump on a call. We'll answer any and all questions that you have. We'll talk about the deal, go through paperwork, etc. And then if the deal looks like something that you want to do, then we reserve a spot for you. And then once we get near the closing date, then we ask you to send funds in so we can close on the property. Once closing happens, then you start getting rental distributions once per quarter. So every single month, we're running the property just like we should. We're getting it turned over. We're increasing rents. We're collecting the rent. And then once per quarter, we pay out the rental distributions. And then when it gets time for us to actually sell the property, we start notifying all of our investors, hey, we're working on the sale, get ready. And then once we've got a buyer for it, then we'll start to send people initial estimates of what our profit is. And then you can make plans to do whatever you want with the profit. A lot of our investors choose to go right from one deal to the next deal. Some investors want to cash out. Any of those are okay with us. We'll warn you with plenty of time in advance of that. That's kind of the full cycle process.
Awesome. Can you go into what a preferred return is? I know some people get confused with that. They'll hear that term up front.
Yeah. So preferred return simply means this: investor, who is the preferred person, puts in capital, investor gets paid from rents before the management team gets paid from rents. So on all these deals, the way that we make money, there's basically 3 spots. Spot number 1 is that we get paid when we close the deal, kind of like a realtor gets paid. There's a commission paid there. That's not the incentive to do the deal. That just helps to reimburse us for some of the costs that we put out to get the deal. Where our big incentive is that when we sell this property, we get 30% of the upside. So you get all of your money back as an investor, and you first get paid the preferred return, which generally we do at 6%. You get paid that, and then we start to split profits. So typically that's a 70-30 split. Investors take 70%. Us on the management side, we take 30%. And then there's one other spot where we can make money. It's not really a money maker for us, but on the month-to-month property management, if we can get the property management done for less than we originally quoted, then we could make money there. That's not a driver for us to do the deal, though. The big driver is 30% of the pie. We want to get that project done. We want to get that project sold. And that's where all of us get to win. We get a big payday at that point.
Awesome. I think that answers a lot of the questions that people have. The other question a lot of people have is there a way that you are ever going to come back and ask for money? What happens if the deal doesn't work out as planned? And it's it kind of plays into our thesis as to why we picked these properties specifically. These aren't investment, these aren't deals where we're going out and building. We're not putting a lot into renovation. We're not moving a property from Class C to Class B. Nate, can you just talk about what are the possibilities that could go wrong and how would we handle that?
Yeah. Great question, Steve. And I've been involved in projects before where there's been cost overruns, and I don't like it at all. And I don't ever want to go through it again in my life. For me as an investor or me as a manager, never, ever. And so when we get into a deal, we're really, really careful up front about budgeting for it the right way. Typically, we actually request more than we actually need so that we have reserves for the property. Anyone that's doing these kinds of deals, if they don't plan for the things that pop up in real estate, they're not doing a service to the investors. We do the service. We're planning for it up front. If we find a year or maybe year two that we're into the project and we don't need all the reserves that we have, then we'll do a release and we'll issue a draw back to our investors for not needing the capital. But going in on year number one, you got to make sure everything is covered. So we don't want to ever ask for anybody to do a capital raise. We never require it. No one is required to do any kind of capital contributions whatsoever.
Awesome. I think that answers all the questions that we normally get. I'm not seeing any in the chat. Nate, are you seeing anything on social?
I can see one of the channels, but I don't have posts from there, but I can't see the other two. So I think we're good. Mike and Marco are in the chat on social right now, so they're taking care of everybody.
Awesome. Well, guys, thanks for joining us. We are going to make this something that happens every couple of weeks. We're calling it the Opportunity Zone. We're going to be breaking down different properties that we've done. We're going to be covering things that have been released in the media, anything that plays into multifamily passive investing. We're going to keep you guys informed because we want to make sure that you make money, whether it is with us or whether another deal out there. We want to give you all the information that we can. Thanks for tuning in. If you do want to hear about our latest deals and you want to pencil in a spot for the one that we have the LOI out on, make sure to book with us. It's homeinvest.com. That will get you there. You'll be able to book at the bottom. You'll either talk to myself or Sue, and we'll be happy to take care of you. Nate, anything? Sue, anything? Awesome.
All good, man.
Guys, thanks so much. Enjoy the rest of your Tuesday afternoon, and we'll see you next time.
Thank you.
Bye, Patty.
Bye.